All right, so this week's webinar is going to be on what is apartment syndication. For those of you who don't know who I am, my name is Dan Handford. I'm one of the managing partners with a group called PassiveInvesting.com. This group is the multifamily and national multifamily syndication group. We're primarily acquiring properties in the Southeast, mainly in the Carolinas right now. I'm located in Columbia, South Carolina, along with one of our other managing partners, Brandon Abbott, and then our third managing partner is located in Charleston, South Carolina, and we're primarily acquiring properties in the Carolinas. So Charlotte, North Carolina, Raleigh, Durham, Chapel Hill area, the whole triangle area there, and then on the South Carolina side, in Greenville, South Carolina, and in Charleston as well. So thank you so much for joining us here on the webinar. If you're interested in investing passively with us in the future, obviously you can go to PassiveInvesting.com, this little link right here. For those of you who are watching it live with us, I'll type that into the screen, so if you wanted to do that, you could. And then on the top right-hand corner of every screen, not on every screen, but on every page on this website, there's a link right here called the Join the Passive Investing Club. If you click on that link right there, there'll be a form there that you'll fill out, and I'll actually have my assistant reach out to you, and we'll jump on a phone call with you to discuss your investment goals and see if your goals align with our goals, and we'll be a good fit for each other. So you can certainly do that as well. And then the other thing I wanted to mention, if I can get one thing out of the way here, is our premium program. So a lot of you on here right now are probably new in apartment syndication, and maybe you want to find out a little bit more or dive a little bit deeper into this multifamily space. And there's a low-cost way for you to do it. And so most of you know that I don't do any one-on-one coaching. I don't have the time for it, so I don't feel like I should be charging for something like that. So we put together a basic kind of premium. I say basic, it's really detailed. We're going to go over the 12-step process today about apartment syndication, and that 12-step process is actually included in this video training, because obviously 12 steps is hard to cover in one webinar, and one kind of 30-minute webinar here. So you can go to mfinpremium.com. There's this link right here, mfinpremium.com. And if you go to mfinpremium.com, you'll be able to sign up for a free trial. It's a 2-week free trial of the program. It's an online video training platform, and we also have some group coaching calls that we do every single week. So you have direct access to me to be able to ask about some of your deals, and we go through all of the process of multifamily, from underwriting to due diligence to investor relations and asset management and acquiring deals and finding deals. And we're going to go through all the different things in that 12-step process. But if you're interested in multifamily, this is a great way to get started. And even after that 2-week free trial, it's only $99 a month to maintain that membership. So there's a lot of benefits included there. So go to mfinpremium.com and check it out and see what kind of benefits you might have from it as well. So let's dive into this webinar for today. So the webinar today is all about what is apartment syndication. So first thing, let's go ahead and first define what an apartment syndication is, because some people will get a little bit confused as to maybe the differences between what an apartment syndication is and maybe some other types of investments in real estate. And an apartment syndication is really kind of where you are pooling the resources and the money from multiple private investors to acquire a larger asset that they would not normally be able to acquire on their own. So to give you a quick example, one of the most recent deals that our group closed was in the fall of last year. It was a $51.5 million acquisition. We closed that deal and raised over $14 million from just over 100 investors in that project. And we were able to close that deal that we would not have normally been able to close on our own by pulling and pooling the resources and the monies from a lot of different investors. And so now that's an example of a really large deal. Obviously, it doesn't have to be that large. They can be pretty much whatever size you want. But I've seen deals that have been down all the way down to $250,000, and they've syndicated it. And I've seen some that are even larger than the ones that we've done. I've seen some over $100 million that they have syndicated. But obviously, there's a process that you have to go through, and we're going to talk about towards the end here, this 12-step process for apartment syndication. I'm going to give you those 12 steps. Now, the second thing I wanted to cover today was the differences between what is an accredited investor and what is a sophisticated investor. And so let's first talk about the accredited investor. The accredited investor is a definition that's based on the IRS guidelines. So an accredited investor is not something that you have to go do. You don't have to go perform something. You don't have to go and pay a bunch of money to become accredited or anything. The accredited investor is somebody who meets one of two things. There's either a net worth requirement or a income requirement. So the net worth requirement is that they have to have at least $1 million of net worth, not including their primary residence. The other requirement, or the other way to qualify as an accredited investor, is on the income side. So if you are single, you have to have at least $200,000, and if you're married, $300,000 of annual income for the last 2 years, and you have a reasonable expectation for it to continue on into the future. So you have to meet one of those two criteria, and if you do, you're automatically an accredited investor. Now, with that said, depending on what type of an investment that you're getting in, there's two different types of apartment syndications in this space. So that's what we're going to talk about next. There's the 506B as in Bravo, and then there's a 506C as in Charlie. The 506B as in Bravo is one where you can accept unlimited accredited investors, and you do not have to certify that they are accredited. It's a self-attestation saying that investor is saying that they are an accredited investor, and they sign off on that when they're subscribing to the project. Now, a 506C as in Charlie is a little bit different in that those investors actually have to verify that they're an accredited investor, usually by submitting some documentation to the operator, or what most operators do is use a third-party service that will verify that they are at accredited status by looking at their financials to determine that they are an actual accredited investor. The service that we've used in the past for a 506C, which we've only done one of them, is a company called verifyinvestor.com. It's a very straightforward service. They charge like $50 to do the verification, and they'll respond usually within 24 hours with that kind of an approval if that investor qualifies. So there's 506B as in Bravo, 506C as in Charlie. And we've done some webinars on the differences, the additional differences between the 506B and the 506C. So I'd encourage you to go to our YouTube channel and type in SEC, rules, or to search for some of those videos, because we did go into a lot of detail with those various types of syndications. That's not what we're going to go over today, but those are the two main types of syndications that are out there: is the 506B as in Bravo, the 506C as in Charlie. Now, what is a sophisticated investor? This is a little bit of a misnomer, not really a misnomer, but there's a lot of confusion around this, because some people think that you either have to be accredited or sophisticated. And that's true to some extent, except for the fact that if you are accredited, you also are considered sophisticated, right? So sophisticated goes across accredited and non-accredited. So really what you have to look at is what is called a sophisticated non-accredited investor. Those two things have to be in place in order for you to invest in these types of assets, whether it be a 506B or, well, 506C is not even an option, because in 506C, you are not allowed as a non-accredited investor, whether you're sophisticated or not, you're not allowed to invest in those offerings. You are only as a non-accredited, sophisticated investor allowed to invest in a 506B as in Bravo. And in that 506B as in Bravo, you are only allowed to invest in, if you are an operator putting that project together in a 506B, you are only allowed to accept up to 35 non-accredited sophisticated investors. So what is a sophisticated investor? A sophisticated investor is somebody who has the financial wherewithal and the financial and background knowledge of business and finance and real estate related matters that they are able to make in a determination and assessment as to the risks and the merits of the investment that they are getting into, right? So it's a very loose kind of definition as to what that sophisticated investor would be qualified as, but they have to meet that qualification and attest to that when they're signing for that particular offering when it's available. So I'm sure you might have a few questions about that. If you do, you can type them into the chat box there, and we'll address them towards the end of the video, or the end of the webinar today. There's two other things I wanted to cover before we actually dive into some of your questions, but as you have questions, feel free to type them into the chat box. We'll have some time towards the end to be able to answer some of those questions. Now, the next thing here is what parties are involved in apartment syndication, and how do each one of these parties make money, right? Because each side of the deal, there's going to be different ways to make money. So let's just first break it down pretty easily. So there's two main sides to every single apartment syndication. There's what is called the GP side, or the general partnership, or what some people also call the sponsorship team, or also the KPs, or the key principals, or whatever. There's lots of different names or places in the nomenclature for that, right? So, and that's the GP side. That's what we're going to call the GP side. And then those are the ones that are putting the deal together, right? On the other side is the LPs, or what are called the limited partners, or the passive investors, okay? So those are the two main sides. Let's talk about the passive investors first, because it's pretty straightforward. The passive investors are basically they're just like they sound. They're passive, and they have limited liability. And when the passive investor puts money in, they wire in, their money, usually usually the minimum is about $50,000 on most of these offerings. They wire that money in. They will receive dividends or distributions off of their investment during the hold period from the cash flows on that investment. So that's how they make money. And then when the asset is actually sold, if there's any appreciation, which we hope there would be, then they would also get additional payment from they'll get their initial capital back, but plus an additional amount on top of that from the appreciation off that asset. Now, the LPs at the end of every year will receive a K1, a scheduled K1, that'll show how much money they received in cash flows and what kind of depreciation they received as well, which typically offsets those cash flows depending on how long you've been into that project. So that's the LP side, the limited partner, the passive investor. Now, on the other side of the spectrum is going to be, of course, the GP side, right? So the GP side is going to make money in a couple of different ways. So first off, they're the one putting all the sweat equity in there. They're usually the ones that are putting the sign on the debt. They're the ones that are putting up all the risk money up front to acquire the asset. And they're also the ones that are going to be managing that asset along the way. So there's a couple of, there's a lot of different ways that the GP can make money. And we even did a webinar on all the ways that you can make money as a KP, or not as a KP, but as a GP, right? On the GP side as a general partner. I'm going to go over some of the most common ones that we actually see in the space so you can actually understand those. So first off, there is what is called the promote, right? That means how much money, how much of the equity is being, not equity, but how much of the deal is going to of the profits are going to be split with the investors, and how much is going to be split with the GP. Typically, you're going to see about 70-30 split. So 70% of the profits will go to the investors, 30% will go to the operator or the GP, okay? That's what's called the promote. It can be different. It could be different than that, 75-25, 60-40, 50-50. Most common though is 70-30. And then on the other, as far as the other way they make money is on what are called fees. So there's typically an upfront acquisition fee, which is usually paid out, and it's usually anywhere between 2 to 3 to 4%, depending on the size of the deal. So the smaller the deal, the higher the fee. The larger the deal, the smaller percentage of the fee, even though the amount of that fee would still be going up depending on the deal that you're going into. Now, once you actually get into the deal, there is what's called an asset management fee. The asset management fee usually ranges from about 2 to 3% on that particular deal. And that asset management fee is for managing the asset. So it's asset management. So where you're typically managing the manager. So you usually will hire a third-party property management company that will manage the asset on the day-to-day operations. And then the operator is going to be managing that manager and making sure that the investment is being protected. And it's going to be continuing to perform as the original business plan was set out for that from the very beginning. And that's a fee that's paid out on a monthly basis for that GP to be able to maintain the staff that is required to be able to manage that asset as they continue to grow. Another fee during the hold period would be what's called a construction management fee. So sometimes the property management company, on top of their fee, will charge a construction management fee, typically about 5% of the overall construction or the renovations that are happening. But a lot of times it's the operator that charges that. Our group actually doesn't charge that. That's not a fee we charge. And our property management company doesn't even charge that fee. So we have that's as a fee that is not actually taken in our group. But some groups do choose to charge a 5% construction management fee, which I have actually seen that happen. And I do have somebody on here, Juanita was asking me, I wish there was a slider presentation to show what you're talking about. So most of my webinars here, Juanita, I don't usually have a slider presentation. I usually will just go off the top of my head, and I actually have some notes and stuff, but I don't usually have the time to put together a nice PowerPoint presentation and stuff. So, but hopefully when you get the recording, you can kind of slow me down a little bit or watch it again and make that list. So let's move forward here. So those are the construction. That's the construction management fee that we were just referring to. The other fee is going to be what is called a disposition fee or an exit fee. So that would be a fee that would be paid when you sold the asset that the operator would be receiving based on the sale price. Now there's another fee in there that has some people charge called a refinance fee, or sometimes you'll hear it called a capital event fee, where if for some reason during the hold period there's a refinance, then they'll get paid a certain percentage, and that percentage is usually 1 to 2%, as well as the disposition fee. Both the disposition fee and the capital event fee or the refinance fee would be around that 1 to 2% mark. Okay, so those are the main fees that you'll see in a deal. Now, there's also one other one called a guarantee fee or a loan guarantor fee. That will be the person that's guaranteeing the loan, and they'll usually get that as well. And that's usually anywhere between 2 to 3%, 1 to 3%, somewhere around in there for that guarantee fee. So all of these fees are not always charged, and they're not always on every single deal, but they're the most common fees that you'll see that'll be placed on these types of assets. So one thing, Juanita, that I do have is I have the list that you'll be very, very glad to see of the 12-step apartment syndication process, which I will go over with you in just a moment. So if you want to go ahead and jot these down, I would suggest you go ahead and opening up a Word document, and I will copy and paste these into the chat box. So you can easily copy and paste these into a Word document if you would like to have these. And then they're also included in the MFIN Premium program, which I mentioned earlier, which is this website here. And you can easily just go to mfinpremium.com to check that out and find out more information about it, okay? So let's do this. I have one question coming in here from Omar. Are the GP the same as the KP? So some people will call the GP the KP and the KP the GP, but technically the KP, which is the key principal, is a member of the GP that is the key person that allows you to be able to secure the debt and to put the deal together, right? So it's usually that main person that has the ability of the net worth and qualifications to be able to sign the debt for these types of deals. So there's net worth and liquidity requirements, and that technically is the KP. And you don't necessarily always have to have just one KP. There could be 2 or 3 or 4 or sometimes 5 or 6 KPs, depending on how many you need to be able to secure the debt that you're trying to get on that particular property. All right, so let's switch the screens over here, and I actually wrote these out for you so you can actually have these. So let's say new share here. And here is the document. So let me move this over on my screen so I can actually see it. I'm going to copy and paste these so that you actually have them in your chat box. Let's see if this works. Perfect, it worked. Awesome. So let's see, the 12-step apartment syndication process. So we're going to go through each one of these things and very quickly. I'm not going to go into a lot of detail because I try to keep these webinars to around 30 to 40 minutes, and I want to make sure I have some time at the end for your questions so that you can have some of the questions that you have answered. So first off, in this 12-step apartment syndication process, you're going to be finding investors, right? So a lot of people say raising capital, right? But I feel like raising capital is too broad, right? Because raising capital encompasses a couple of things on here. It includes this finding investors as well as securing capital, and also this investor relations piece. So it's not as simple as just raising capital. Like, where are you raising it, right? Because when you're finding investors, you're not usually asking them for a commitment right then. You're usually trying to just find people who are interested in potentially investing with you. So that's the first part here, is this finding investors, okay? So this is the first step here, finding investors. The next thing is locating deals, right? Locating deals, meaning you're trying to work with brokers or trying to find off-market deals and acquisitions and doing driving for dollars, and you're doing this whole acquisitions process, if you will. The next is this underwriting phase, so knowing how to actually analyze a deal to a point where you actually know how the returns are going to be coming in for that deal, and what kind of returns you're going to get for the investors, and what kind of returns you're going to get for the project itself, and of course for you as the operator at the same time. This is an important piece because even if you decide that you want to be just a passive investor instead of an active investor, this is really important because you'll be able to understand how deals are underwritten, so you can kind of see if there are any concerns or flaws or questions that you might want to ask the operator before you invest. And it'll also make you feel more comfortable when you're reviewing a deal to make sure that the assumptions that are done on that deal you're actually comfortable with as well. So underwriting is a very, very important piece when it comes to multifamily syndication or apartment syndication. Either one is the same, I guess. And then, of course, here we're going to be reviewing deals. So once you actually have that underwriting, you're going to be reviewing those deals to see which ones you want to actually submit offers on. And then you're going to go through and actually submit offers, right? You're going to be submitting offers, what we call our LOIs or our letter of intents. And then those will go through a couple of different rounds of different offers and getting to the point of hopefully being awarded the deal. And once you get awarded that deal, that's when this phase comes in of securing the capital, right? Securing the capital is really what I like to think of as you now have a deal, you now have an amount of money that you need to raise for that deal, and now you have your investors that you found in this first step up here, right? And now because you've found all those investors, now you have the ability to secure the capital from those investors, and now that's a different process, a different phase in this process where you're actually having to put in a system in place to actually be able to effectively and efficiently raise capital for your deals. Then the next one here is financing, right? You obviously, this would probably go a little bit higher up because in order to underwrite a deal properly, you have to know about financing. But financing is a very important piece when it comes to securing the debt for these assets and making sure that you secure the debt that's appropriate for the actual business plan for that property as well. And of course, going through the due diligence process and phase whenever you're acquiring the property, when we're talking about on-site due diligence, but also financial due diligence. There's two different aspects of due diligence when it comes there. And then there's also lender due diligence as well, which is kind of encompassing a whole other set of process there. And of course, we have the third piece of the kind of raising capital, if you will, which is our investor relations. And this investor relations is after you've closed on a deal, how do you maintain that relationship with the investor to make sure that they are continuing to be aware of that investment that they have just put their money into, and they can be continued. They don't have to be reaching out to you saying, hey, how's the deal doing? You being proactive and letting them know how the deal is doing before they even ask. And so we talk a lot about that, the MFI and Premium program. And this is the spot that I love the most is investor relations. This investor relations, securing capital, and finding investors is where I really enjoy. That's the part that I really enjoy, and I focus a lot of time and attention on. Asset management is another very important, crucial piece. This asset management has to do with how are you going to be able to manage this asset to a point where you can make sure that the money that you've actually raised for this is safe and secure. And so putting together a process to make sure that you effectively manage the asset is very, very important. And this is all encompassing. This also includes knowing when to refinance, knowing when to sell, knowing when to pivot. Right now we're in the middle of this COVID-19. What are you going to do right now, and to work with your property managers to make sure things are being protected and right now, and making sure that you don't lose your shirt in the middle of all of this if the rents don't come due. So this whole asset management piece is very, very crucial and very important. The 11th step here is about renovations, knowing first off how to actually budget for renovations and estimate what it's going to cost you to do renovations. And then also on the renovations, making sure that you work very closely with the property management company to make sure that the renovations are going as planned and they're not going over budget, and hopefully staying under budget. And that you also have to be, with the renovations, maintaining a relationship with the asset management side as well, because when you're doing renovations, you're hoping to get a certain premium on your rents, and you want to make sure that you can achieve those premiums as you're doing renovations and having that constant communication back and forth. And then of course the last step here is once you've actually found that deal, acquired that deal, raised the money for it, closed on it, held the property for a certain period of time, did your asset management, did the renovations, and you're now ready to sell that asset. How are you going to sell that asset? Or are you just going to refinance it? So, you have to make those determinations along the way during this process to see what is going to be the most advantageous thing for you and for your investors. And that's going to be a very important piece here. So let me open it up and see if anybody has any questions. So I have one question coming in here from Bobby. And so I'll answer his question, and if anybody else has any other questions, I'll open it up for you there as well. And I know I went through this 12-step process fairly quickly. Each one of these could be its own probably 5 or 10 different webinars, if you will, which is kind of how we built out the whole MFI and premium program is to really get that all these different pieces, fleshed out and laid out for you, so you have a better understanding of that. So I would definitely encourage you to do that. I know several of you on here have already, subscribed to that, so I really appreciate that. But go to MFI and Premium and sign up for it. It's a no-brainer. It's a 2-week free trial. Go check it out. If you don't like it, just send us an email and we'll cancel your subscription. And there's no contract with it. Just you can cancel it, or you can start and stop it whenever you want. Okay, so. Bobby has a question here. For new GPs that do not have a lot of personal capital to invest, is it acceptable to our investor pool that we put our acquisition fee back into the asset? So yes, Bobby, that for the most part, that is not a problem at all. Now you might come into an issue with maybe from the lending side, because some lenders will want to see that you have some extra skin in the game on top of your acquisition fee or your whatever fees that you're charging up front. So they'll want to typically see that, but it depends on the lender, because every lender is just a little bit different. The agency lenders like Fannie Mae, Freddie Mac are a little more strict on it versus your more private loans or your bridge loans, your life insurance companies, your CMBS, those types of lenders. But it really just depends when it comes to that's concerned. But I'm personally invested in about 21 different passive syndications myself with 8 different operators, and one of the things that I look for is I want to see that the operator has skin in the game, right? I want to make sure that they have capital at risk. And so I like to see at least a minimum of $100,000 in the deals that I invest in. It's just a minimum criteria that I set for my own investments, because I just feel like that's a good, comfortable a number, and it's a significant enough number that that will make sure that operator manages the investment very closely. But I don't mind if somebody rolls in a portion of their acquisition fee or whatever into it to be able to meet that minimum amount that I like to see. But it is not a requirement for the most part, unless the lender requires it as well. So Omar has a question here. How many people can be or normally is in the GP team? So there's not really a minimum number, or I guess the minimum is 1, right? There's not really a maximum number of people that you can have on the GP team. I don't like to see any more than about probably 5 people on the GP team. Because it can sometimes be too many cooks in the kitchen, if you will. And when you have too many cooks in the kitchen, sometimes the recipes just don't come out too well, right? So I like to see between about, I like to, at a minimum, I like to see at least 2. Like I don't want to invest with anybody if it's just one person on the GP team, because I've seen too many deals that have gone south because the operator went ghost on them, and they couldn't find the operator, and they pretty much have tied up their money and they can't get it back for a long time, or at all. And so, but the chances of at least 2 or 3 people going ghost on them and not responding to them is a lot less likely than just one person. So I usually will only invest with somebody if they have multiple people on that GP team. So then Paras is having a question here. Not sure if you plan to cover this further down, but can you walk through the deal analysis and what are some key points to highlight to passive investors when finding investors and securing capital? So a couple of things that I'll point out here, because we've covered this in a couple other ones. Actually, let me do this. There's actually a webinar that we did on this recently called the Red Flags for Passive Investors. And let me see if I can find it real quick. And in the chat box here, I'll type it in there. And for those of you who are watching the recording, you can, on the recording, you can go to our YouTube channel and just type in Red Flags, and you should be able to find this video. It was actually a fairly popular video that we actually did. Let me see if I can find it here real quick. It's called Red Flags for Passive Investors. We did about, looks like here we did it about 4 months ago. And this would be a good one for you to review, Paras, because I go into a lot of detail about, it's called the Red Flags for Passive Multifamily Investing. And one of our other partners, Daniel Randazzo, was on this call with me as well. And so I just put it into the chat box there so you can have that link, and everybody else can go on to YouTube and just type in Red Flags for Passive. You just go to YouTube and just type in Red Flags for Passive Multifamily. I'm pretty sure it'll show up. Let me see. It does. It's the #1 video that shows up, Red Flags for Passive Multifamily. and you'll see our video there. It has a big old red flag on it. It says red flags for passive investors. So I would definitely encourage you to do that to find out a lot more about what you should be looking for when it comes to analyzing deals and different key points to be able to understand when you're investing passively in another group. So Omar has a question, another question here. Can a member of the GP team be more passive than the other members, probably because of distance or any reason? So it's possible, obviously, for them to be more passive, but you can't have somebody on the GP side that's, you know, doing nothing, right? Especially if they're bringing in other investors that are in their network. They have to be doing something actively outside of just investor relations, if you will. But I mean, you can gift GP side to do just about anybody, I guess, if you wanted to. But if they're on the team and they're bringing on investors, they have to be doing something other than just that. And so there's things that from an asset management perspective that most of these people can do. For example, jumping on a phone call every quarter, going over the T12 and the rent roll and the finances, and making some answers around that as well. So you know, there's definitely, you know, impact. You know, there's definitely things that you can do from remotely that doesn't necessarily cause you to have to be close to the asset, if you will. All right, so let's see here. Looks like we have another question that's come in here from Steve. Let's see, insights on impact on current properties and what about future deals? So Steve, this is all about COVID-19 right now. So we actually did a video last week with myself and Danny Rendazzo, and then also my other partner, Brandon Abbott. So you can actually, let me just do this. I'll type into the chat box here the link that we did to that video last week. And the title of that video was Multifamily Investing, Response and Impact of COVID-19, the Coronavirus. So we did that last week about the economic outlook for apartment rental demand, discussing the impact with different markets and different properties and various things like that. So I definitely encourage you to go watch that video there. And then let's see here. One of the other things that we're going to be doing is, let me actually change my screen here so you can actually see this. New share here and go here. So this right now, if I just refresh this screen, let's see if this works. Okay, it's not working here. Let's see, MFI and webinar. All right, so it doesn't look like it's updated just yet, but we actually have another update coming up next week on the COVID-19. So make sure you check your emails, and we're going to be sending out an update for you to do it, for you to be able to see this. So let me see if I can get this thing to go one more time. Sometimes it takes there's a little bit of a delay for it to update whenever we update it, whenever we process it. So we'll send out an email for all of you who are on here to be able to join us next week, which we will go into a lot more detail. And let me actually open up a couple of topics that we're going to be talking about next week. Next week, we're going to be talking about how the CARES federal stimulus, the stimulus that was just passed last week, will benefit multifamily operators that have been impacted by COVID-19. So we're going to review it, and we're going to review the CARES Act in detail. We're going to go over what multifamily operators can take advantage of within this act. And then we're going to talk about other federal programs that are available for operators during this difficult time. And then, of course, April rent is now due. And so we're going to talk about different steps that you can make to ensure that your residents have the money to be able to pay their rents as well. So we'll actually send out an email to you so you can register for that one and be aware of that one that's going out. All right, so we have another question on here. It says, can you also describe a little more detail on reviewing deals? So in the 12-step process for reviewing deals, this is where you're going to make sure that whenever you have a deal that's come across and you've underwritten it, we like to do what's called an initial underwriting. You want to see, does it actually, on a high level, fit the criteria to actually move forward with the deal? Is it the right asset class? Is it the right market? Is it the right returns? How are the IRRs coming in? What about the cash on cash and the equity multiple? The annualized return. Where is this deal coming in? and what do we need to do from a renovation standpoint to be able to achieve the rents, to be able to achieve those returns. And so that's really what you're looking at when it comes to reviewing the deals. It's really kind of on a high level first, and then once you fully underwrite the deal, you'll do an even deeper dive on actually going and reviewing the deal by doing an on-site tour and due diligence and things like that to continue to be reviewing the deal throughout that process. So Mike has a question here for general guidance. I know each deal is different, but you offer preferred equity for your investors, 7 or 8%. If so, I'm assuming the property must have cash-on-cash percentage in the double-digit range. So it doesn't necessarily have to have double-digit range cash-on-cash. It just has to have cash-on-cash that meets the preferred return. So it's different. Preferred equity is different than preferred return. So a preferred return means I put in a certain amount of money, and I'm going to make that certain 7 or 8% before the operator actually makes any money off of it. Preferred equity means that you're in a different stack in the capital stack, different position in the capital stack, which makes your equity preferred versus everybody else. So technically, I guess if you have a preferred return and you're at the bottom of the capital stack right next to the debt, then you would be in a preferred equity position based on the GP equity. But a lot of times you'll see two different LP equities where you'll have a Class A share, which is a preferred equity stack on top before the Class B shares. And then the Class B shares are set up so that they get that preferred return as well, but they also have participation in the upside, but they are only paid after Class A. And there's also kind of different tranches that could be raised throughout the process. That's a whole like waterfall discussion that we can get into, which we don't have time to go over today, but you don't necessarily have to have the cash-on-cash in the double-digit range in order to meet that 7 or 8% preferred return. You can have 7 or 8% in cash-on-cash to actually meet that preferred return as well. Now, do you want to have more than that to kind of give yourself some extra cushion and room for error? Yes, absolutely. You'll definitely want to be able to do that as well. All right, so I just got a couple of questions in here. Let me see if I can answer some of these. Can you syndicate the down payment, the option fee on a multifamily deal purchased through a master lease agreement? So you could. You're probably getting into more of what would be called a JV, probably more than anything. It's like a joint venture agreement with people that you wanted to kind of co-syndicate or really kind of co-JV, if you will, or partner with on that particular down payment. But on the down payment side, you might actually be better off to kind of get I'm not really exactly sure how you would do this, but you would give on the down payment, you could, if they participate in the down payment, then they could have a piece of either the GP side or the LP side based on the amount of money that they put in. You could certainly do that as well. How do you address equity splits versus voting right percentages on the GP side? Does there have to be a parity? So there doesn't necessarily have to be a parity. So you can set it up in your operator agreement however you want. You can make it so that just one person or two people have the majority voting rights. And so that you can set that up. Just depends on if everybody on the GP side actually agrees with that. So on the LP side, they have no real voting rights. So the voting rights are all based on the GP, and the LPs are actually giving up all their rights to the GP to be able to manage that asset and make all the day-to-day decisions. Can you use bridge lenders, hard or private, to raise your closing costs and down payment? Yes, you can. So you're able to do that with these types of loans without any issues. But you typically, in order to sign on the debt, you have to have two things. You have to have net worth of the loan balance that you're trying to acquire, and you have to have 10% liquidity of the loan balance as well. And you have to maintain that liquidity position the entire time during that hold period. So you do have to have that in order to acquire these. So you could use a bridge lender, or I wouldn't necessarily call it a bridge, but more of like a hard money lender or a private loan to raise your closing costs and down payment. But again, you have to understand that in order to get these loans, you still have to have someone on your team that meets those requirements for the loan to be able to sign up on those loans as well. Let's see, can you also describe, okay, we got that, try again, let's see. Let's try to refresh this, see if it comes up. Nope, that didn't work. Let's see, MFI webinar. Perfect, there we go. It has been updated. So let me actually get this link to you. So for those of you who want to join us, you just go to multifamilyinvestornation.com/MFIN webinar. You can click this link that I just typed into the chat box there, and you can sign up for this webinar that we're going to talk about the CARES federal stimulus that benefits multifamily operators that are impacted by COVID-19. So make sure you register for that. We're going to be diving into a lot of detail with that as well. All right, so let's see. Which known registered independent advisor firms specialize in working with syndicators to raise capital for multifamily deals? So I don't know a lot of these RIAs that actually work with syndicators for raising funds, mostly because they want to continue to hold on to their assets and make the fees that they want with it, right? Because these independent advisors are usually making money based on the overall portfolio size, and whenever they're investing in a syndication, it's kind of outside of their quote-unquote portfolio, if you will. Now, I do know that there are some broker-dealers out there that do a lot of placing of capital in large, like 1031 exchange deals, where they're actually 1031 exchanging proceeds into what's called a DST, or a Delaware Statutory Trust. And you do have to be a registered broker-dealer in order to place capital like that. But there's not a lot of registered independent advisors that are, specializing in working with syndicators to place that capital, mainly because they have to have certain broker-dealer registrations and requirements in order to do it. Let's see here. What would be the best way to transit from a passive investment position into a GP role in a multifamily deal? A newbie will need to walk hand in hand with an experienced team member, add value, and learn a ton. So how can that happen? So one of the things that you can do is help to co-GP or co-syndicate with somebody else that can kind of help bring you alongside their deal. That's one of the things that we did when we first got started. Is we didn't just go out of the gate raising money for our first deal. We actually co-GP'd with a couple of operators first and raised for and participated in 2 or 3 different deals. And we raised money for the deal. We participated in the asset management. We participated in the ongoing due diligence, and participated in a lot of different pieces of it to learn those different pieces and ropes, and then before we actually put together our very first deal. So that would be the best way to do that. The hard part is a lot of times if you don't have a mentor that can kind of bring you alongside, it's hard to have that piece in play, right? Because you have to find the right person to be able to partner with, and you have to have some sort of quality or benefit that you're bringing to them for them to bring you alongside them to be able to do that. So it's one of those things where you just have to know enough people, and you have to be networking with enough people and going to live events, which right now with COVID-19 is a little bit hard to do, but going to a lot of these live events and networking with a lot of people, and even people that are part of our MFI and premium program. There's a lot of people that are part of that get to network with each other and learn from each other, and build relationships and potentially do deals together. So there's different ways that you have to be able to connect with people that are doing things on a high level to make sure that you do that. All right. So Jasmine's asking, does the LP agreement spell out the KPGP LP rules and obligations? Yes, it does. So there's what is called a PPM, the Private Placement Memorandum, and that includes all the disclosures and also the operating agreement for the property. It includes the investor questionnaire, and it also spells out how the distributions are going to be made and everything like that. So and how all that works. So it's all spelled out in those agreements. And that's why you have to watch those and review those very closely, because that's actually where they actually are going to be able to make decisions that are based on how the property is actually going to be performed once you actually get into the project. So last question here I'm going to take, because we're right at about 45 minutes right now. What pre-tax and after-tax IRRs are normally investors looking for? So I would say in 2019, if you were to ask me this question, which now we're kind of in the beginning or beginning of the second quarter, if you will, of 2020. If in 2019 you would have asked me that, I would say typically between about 16, 17, 18% IRR on a typical 5-year hold would be what most investors are looking for. But right now, given the whole way the market has gone, the market has tightened up, and it's also getting a little bit more challenging. And I think you're going to be looking at deals that are going to be more like 13, 14, 15% range. And I mean, if you know anything about underwriting, I can make deals look really, really good, right? I can do some things to manipulate the underwriting to make it look better than it really is, but you also have to make sure that you do things conservatively. And our group, PassiveInvesting.com, our goal is to conservatively underwrite the deals and under project our returns so that we can under promise and over deliver. So I would rather tell you I'm going to get you a 13, 14, 15%, and then actually achieve a 15, 16, 17 on a deal versus telling you 15, 16, or 17, and then just so happened I can only do 13, 14, or 15%. So you have to kind of take all of that into consideration when it comes to the IRRs that the investors are looking for. Now, after-tax IRR is a little bit different because it's hard because everybody's going to be in a different tax bracket, and the benefit for the taxes are going to be a little bit different as well. I'm in the highest tiered tax bracket myself, and so my IRRs are actually in the 30% plus range because of the amount of money that I'm able to keep from the depreciation benefit that I'm getting off of my investments. And I can actually, because I'm classified as a real estate professional, I can offset some of the other income that I'm generating from the medical clinics that I own, as well as the other businesses that I actually own as well. So there's a lot of different nuances there when it comes to the taxes that can benefit people on different ways. Well, thank you guys so much for being here. If you want to go ahead and register for the next webinar, I'll type it into the chat box here one more time. And then while you are sitting here, after the webinar and you're ready to do this, dive into our premium program, mfinpremium.com. We'd love to have you join us there. Love to have you learn from us and benefit from us there. Just go ahead and dive in and get that 2-week free trial. You can cancel anytime. So thank you so much. We appreciate you for all your attention here and being a part of this. Look forward to having you on the webinar next week as we dive into this CARES stimulus package that can benefit multifamily operators.